Chapter 9 is about financial institutions. Financial networks is a network of savers, borrowers, and financial institutions. This could include banks that work together to transfer money from borrowers to the bank, from banks to borrowers. A definition for savings you should know: money that you put aside for future use. And a definition for invest: this is money that savers put aside to make savings and growth. Entrepreneurs need money for capital and other resources, and so they go and they borrow money. Where does the money they borrow come from? Well, it comes from savers like you and I that go and deposit our money at a bank, and those banks have to keep a surplus, which is called a reserve. Then there is a certificate of deposit, which is basically showing that you have made a deposit at the bank and that you are going to get your money back with interest at a certain rate. It's a little higher rate of interest than a savings account, but not much. When you open a savings account or you buy a CD of some type, you get a receipt showing that you have entrusted the bank with your money. This receipt represents a financial asset. There are all different types of financial intermediaries. One type would be a bank, an institution that deals in money and provides a variety of financial services. Banks accept deposits and they make loans. Banks also provide three basic services. They keep your money safe, they transfer funds, and they loan. There are many different types of banks. Essentially, they provide the same services with a few differences. A commercial bank at one time only served businesses. Primarily now they serve anyone. A thrift institution was often classified by savings banks, savings and loans associations, and then credit unions, which were initially brought about to provide like emergency loans for members, such as the UAW. Credit unions are pretty much open to anyone. I'm a member of a credit union. I paid $5 to join. Other financial intermediaries: finance companies, life insurance companies, pension companies. A finance company loans money directly to consumers, and this is a type of an installment loan. American General is one that's well known around here. A lot of times these are high-risk loans. They do a lot of the 12 months, same as cash loans, which means if you pay your purchase off in 12 months, you do not have to pay interest. If you don't pay it off in 12 months, then it means that you would pay interest from the first date of the loan. And usually the interest rate on these loans are very high. So people that are at high risk are also those that are less likely to repay a loan back. Keep in mind that finance companies do not take deposits from customers like a bank does. They only loan money out. Life insurance companies are also considered financial intermediaries. They are to provide financial protection for survivors of an insured. They also do not get funds through deposits. When someone buys a life insurance, they promise to pay a premium that can be monthly, quarterly, or possibly annually. And in return, when the person who is insured is deceased, the life insurance policy money will go to the beneficiary of the policy. A pension fund is a retirement plan that provides a fixed amount of income for life. There's not a lot of pension plans left out there. Teachers still have a pension plan right now. And so after so many years of work, I will be able to draw out a certain amount of money per year for the rest of my life. Lesson 3 kind of amps things up a little bit as we talk about markets, bonds, stocks, and how those work in the financial field. As a way of earning money, corporations can raise money by selling stocks, shares of ownership. We talked a little bit about that in Chapter 8. By doing so, they expand the number of people who actually own part of their company, and they're able to raise money to expand their business. They can also issue bonds. bonds are basically an IOU. And so if you buy a corporate bond, you are loaning your money to a corporation, and in return, they will give you your money back plus interest. You can also do certificates of deposits. They are also considered financial assets. Again, those are bought and sold in markets just as other goods and services. And there are two kinds of securities markets or exchanges, and those are primary and secondary, and you will want to know the difference between those two. The primary market is where trading for newly issued financial assets takes place. Most know little about them, and they're usually only sold through some type of investment banker. So you and I could not go to the primary market and do business there because we are not an investment banker. An investment bank is a bank that acts as a broker. So they are the intermediary between an individual or a firm that sells securities to the public. Investment banks primarily sell to insurance companies and pension funds, not to individuals. The secondary market is where existing financial assets are resold. This is where you and I, as an everyday consumer, could go and do business. A capital market is an example of a secondary market. A secondary market allows investors to sell some type of asset that they have quickly and without penalty. A capital market is where government and corporate bonds are kept for more than a year, are bought and sold. So these would be bonds and government and corporate bonds which are at least 1 year old. And then the money market is a place where bonds that are going to mature in 1 year or less are traded. So you can see that the secondary market has different levels and different markets where different products are bought and sold. As far as stocks, mutual funds, and futures, these are all investments. Some of them are higher risk than others. And financial assets are not the only purchase that investors can make in the security market. They can buy equities, which are ownership shares, stocks. These are bought and sold through organized security exchanges, and we'll talk more about what those are and what their names are and the characteristics. If you buy through a security exchange, you are going to have to pay a fee to join that exchange, and trading only takes place on the floor of the exchange. Now, talking about the New York Stock Exchange, this is the biggest stock exchange in the world, and you do have to pay a fee. So again, you and I cannot go on the New York Stock Exchange and do business there. I will show you a couple videos in class about what the market looks like, how it operates. Again, the largest exchange is the New York Stock Exchange. There are 1,366 seats of membership in the New York Stock Exchange. The stock exchange has the right to elect their own directors and vote on rules and regulations. There are 280 billion stocks listed on the New York Stock Exchange, and there are over 3,000 companies. So you can see by those statistics that many companies have multiple stocks that are sold on the New York Stock Exchange. Amex, which is also located in New York City, is also a stock exchange. There are only 1,000 stocks listed on this exchange. It also has regional exchanges in Chicago, Pacific, Boston, and Philadelphia. Stock exchanges can also be found in cities around the entire world, London, Tokyo, Hong Kong, to name a few. Most stocks that are bought and sold in the United States are actually traded in the over-the-counter market. So similar to you and I going to CVS and buying an over-the-counter drug where any of us could walk up and buy some Benadryl or some acetaminophen, this is what the over-the-counter market stock exchange is, where you and I could go and do business. Now, the NASDAQ is a listing that provides information about the stocks that are sold in the over-the-counter market. There are two indicators that people in the investment world use to look at the stock market and how things are advancing. The two most important ones are the Dow Jones Industrial Average, and we looked at that in class, last class period, and the Standard & Poor 500. The Dow Jones, again, the most popular measure of the New York Stock Exchange, began in 1884. So this is a very old average that has been around for many, many years, seen many, many changes. And the Standard & Poor 500 uses 500 representative stocks as an indicator of the overall market performance. Unlike the Dow Jones, it includes stocks that are listed on the New York Stock Exchange, the Amex, and over-the-counter, where the Dow Jones is only measuring stocks on the New York Stock Exchange. When we look at how the market is operating, there are a couple terms that is widely used in the market world. One is a bull market and the other is a bear market. When stocks are high and the market is really strong, it's known as a bull market. A way to remember this is a term, strong as a bull. Also, another way to think about it is the horns of a bull are pointing up, and that means stocks are strong and growing. This is a good market, and I would consider us in a bull market right now with the Dow Jones above 16,000. When stocks are low and the market is very weak, it's referred to as a bear market. Mean as a bear. Claws are pointing down, which means stocks are losing strength. And we were in this type of market in the recession of 2008, 2009. Probably wasn't till 2010 or 2011 that things started looking up, and we headed toward that bull market that we are experiencing right now. When you invest in the stock market, one thing that you want to do is look at your risk potential. During a bear market, it's very risky, and you could stand to potentially lose every penny that you invest in stocks. One of the ways that you can minimize your risk is by investing in mutual funds. And mutual funds is a company that sells stock in individual investors, and then they invest that money it receives in stocks and bonds that are issued by other corporations. So this spreads your risk out, not just over one company, but over many companies. So a mutual fund can be bought and sold just the same way that stocks are. They receive dividends just as other stockholders do, and they also have a net asset value. So they're very similar to buying stock, but they are less risky because you are spreading your risk. Another way of minimizing the risk is that you can trade the future, which means that you can have a contract that is for a future bought and sold date at a stated price. So you might state your price now and say that I'm going to buy it at this price in the future. Another way are options, which is the right to sell a commodity or buy a commodity at some point in the future at a predetermined price. Similar to futures is that they are based on a future event. Different in that options give the buyer and the seller an opportunity to back out of the sale. They're both bought and sold in the same market, but options, again, you get that right to possibly back out, and in futures, once you've signed that contract, you're tied to it. This is just a little table that you might want to look at to know what the potential, you understand that risk and potential profit are correlated. So an option or a future, there's a very high risk. There's also a very high risk of potential profit. In a stock, you have a moderate risk or moderately high risk, and there is a high potential profit. You can also lose everything in a stock. In a bond, there is a much lower risk, but you are not going to earn the potential profit. A bond is going to have a set percentage that you're going to earn in interest, and you're not going to gain any more than that. And in today's market, that is probably going to be less than 5%. So we'll discuss more of these